As of the end of September, the valuation of the market was within 5 to 10% of the lows that we reached in 2008 financial crisis. So even if you think that the current crisis is as bad as 2008, which in fact is not, we are already very close to the low at that time. There is a good scope for at least a short-term recovery. What is really interesting now is we talk about the medium-term outlook, because we are long-term investors. We think there's a 60% chance, most likely case of U-shape, 20% chance of V-shape, and 20% chance of a collapse. In a U-shaped recovery, it's not going to be an easy investment environment. It's going to be very volatile. And unfortunately, at the moment, for me, this is the most likely situation. Inflation in developing countries will remain high, but in the developed countries, I think you may have a chance of very slow or low inflation, or even some deflation. So it's a two-tier world. Interest rate remain low, you could have some social unrest, and definitely economic growth will be slow. But it doesn't mean we have a recession. And just very quickly to remind you, here in the developing countries, or like Asian countries, we still have some problems with inflation. That's why the Chinese government cannot really fight very hard this time. They are afraid that if they stimulate the economy again, inflation will go crazy. And also, we have another problem is that interest rates on bank deposits are negative. That means the deposit rate is below the inflation rate. In China now, deposit rate in a bank, the interest rate they pay you is 3.5%, but inflation is 6%. So when you save money, your purchasing power is eroded. So even this likely scenario, which is considered to be an okay scenario, is actually quite a lot of problems. Anyway, let's go on to our action plan. No use just talking. What do we do about it? The main point in the action plan is that you should advise your clients to diversify, prepare for a very wide range of possible outcomes. The second point is that in your decision-making and analysis, please keep an eye on the physical world, not the financial world. For me, I have a team of about 40 people doing research for me in the Value Partners team. We've been doing research for 18 years. Our preferred sectors are energy, coal and oil, precious metals, especially gold, anything related to farming and agriculture and food, China-related stocks, and companies with really big brand franchises, because these are the guys who can, if there is price increase for the raw material, they can pass on the cost to the customer. For people like me, gold is simply, it's an insurance policy against the government's printing too much paper money. So eventually collapse the confidence in paper money. Personally, I think that it is okay to put up to maybe like 10% of your wealth in gold. With China, I know that some of you read about possible hard landing for China. Hard landing means the economy just crashed very badly. I don't think it will happen. The Chinese government still have huge reserves to fight, unlike the US government, against any kind of real problem. And also some people say China is very dependent on exports, but look at the real world. The truth is exports are no longer an important contributor to China's economic growth. Growth now comes from domestic spending and consumption and local domestic investment. China has become less and less dependent on exports for its growth. My last point before I leave is that if indeed equities is the solution, or the main but not the only solution to these difficult scenarios that we now face and the uncertainty, what is the best way to invest in the stock market? Now, the most important point about the stock market you should remember is that stock markets are not efficient. There was a theory about efficient markets theory. Now, this is totally untrue. In real life, stock markets do not price things correctly. So the value investing, which is the method we use, in my opinion, is almost the perfect way to take advantage of this. Okay? That's my conclusion. Thank you.